So Ed, what's your outlook for the U.S. economy and inflation over the next 12 months?
When we think about the outlook for the U.S. economy, let's break it up into two parts. First, the outlook for the U.S. economy, and I do think there's some really positive dynamics behind the kind of growth we're seeing. And first and foremost, that is a lot of the momentum that has built as we've moved to a reopening. So moving into this post-pandemic period and seeing a lot of the pockets of the economy opening back up, and certainly that's driving a tremendous amount of activity. But really, it's just part of the story. Other really important aspects of the economic growth that we're seeing is that we still have very accommodative policy, both monetary and fiscal policy, that we really expect to remain, in that very accommodative mode over the next 12 to 18 months. Taking it a bit further and seeing kind of where pockets of strength exist, a lot of that is tied to the consumer. So we do view the consumer as kind of coming through this period, certainly because of a lot of that policy accommodation, in a fairly healthy position in terms of consumer balance sheet strength, in terms of significant excess savings that we think will drive a lot of the pent-up demand for goods and services that exist. So really, when we think about the economy, there are a lot of really nice tailwinds. Now, it's certainly not without risk in terms of what we see from variance and the impact that could have on economic activity. Now, when we think about inflation, it's a bit of the other side of the coin in that we are seeing some pressures. Now, certainly transitory has been the word of the day as it relates to the outlook for inflation in the economy. And we are seeing, at least initially, some pressures on the price front that, at least initially look like they are more related to some of the dynamics with the reopening. And, this is a very unique time in economic conditions where things were shut off and then begin to reopen, and it's created some of those tensions. Supply chain bottlenecks would be, a great example of that. We would describe that as pockets of kind of heat as it relates to inflation. I think constructively we are seeing some of that cool more recently, but we still have concerns that some of the pressures will potentially last a bit longer. And I think right now there's a lot of focus on the investment team as it relates to what exactly does transitory mean, how long can we sustain transitory inflations before fears develop in the markets that it may be a bit more persistent. And certainly that's important, as it relates to one of those key pillars that's driving economic activity, which is policy accommodation. And I think that's something that we'll certainly watch very closely here in the second half of 21 and as we enter 2022.
What are the investment opportunities and risks for U.S. equity, fixed income, and convertibles over the next 12 months?
First let me take the view from an equities and convertibles perspective, because I think those are very similar in nature and really are tied to a lot of what we've seen play out over the last 12 to 18 months. First, as we entered the pandemic period, shutdown in the economies, there was tremendous divergence in markets. So very narrow participation, very narrow group of kind of winners, and a very difficult time for many other companies that were more directly tied to the decline in economic activity. Then certainly as we made our way through, and it was clear we had vaccine developments happening, and we're going to see a reopening of activities, it really swung completely to the other side, and we saw a lot of catch up and kind of convergence in that opportunity set. Today, as we look across equities and convertibles, we actually find a very broad set of opportunities. As it relates to fixed income, we're certainly in a very different period. Rates fell tremendously during the pandemic, and while they've increased, they're still at a level that makes it fairly difficult to find attractive opportunities. So yields remain very low across the fixed income sectors, and the prospects for attractive total return are also therefore somewhat limited. That said, within certain pockets, in particularly corporate credit, non-investment grade corporate credit, high yield corporate bonds, floating rate term loans, there are pockets where we find that very favorable economic backdrop supportive of corporate fundamentals, and those are areas that we are finding some opportunities within fixed income.
So why should investors think about multi-asset strategies? How could those be more beneficial for long-term investors?
As we think about multi-asset investment strategies, the real advantage is the flexibility that we have in our asset allocation. So considering a very broad range of investment opportunities across asset classes really enables us to be fairly dynamic in the way that we look for opportunities and deploy them over time. And I think against the backdrop that we have today, where markets have performed fairly well, valuations appear more full in general across financial assets, having that flexibility is really key, as well as that kind of nimble approach to take advantage of any dislocations that may occur in different markets.
What are some of the key investment themes and sectors in your portfolio as we look into the second half of 2021?
When we think about the overall portfolio today, maybe starting at the highest level and the asset allocation mix that we have, we really had an opportunity during the pandemic to move away from some of our fixed income exposures and really increase the overall equity content in our portfolios. That most directly happened by increasing common stocks, but as well into kind of hybrid assets, convertibles, and equity-linked securities. That was the most significant kind of theme at an upper level. Within our fixed income positioning, we generally really tried to bring down interest rate sensitivity within the portfolios and really focus on that incremental yield or spread offered by corporate debt securities. To kind of take it a little bit deeper and think about sectors, we've actually found that there's a lot of opportunity across a broad range of sectors. So thinking about the major sector positioning, including financials, healthcare, technology, utilities, energy, so really broad cross-section of economic activity where we're finding opportunities within those three major asset classes: equities, convertibles, and fixed income.
All right, that was episode 1. Ed, with the major indices fluctuating near all-time highs, do you think it's still a good time for investors to get into markets?
Yeah, as we look at markets, certainly they've benefited from the very favorable backdrop that we have today in the economy. As we've kind of talked about, the growth that we're seeing now is significantly above long-term trend growth in many economies, particularly in the developed markets. And certainly that growth is driving an increase in valuations. But as we look at individual companies, we're seeing that today as we are currently in the midst of an earnings reporting season. Companies are delivering very, very strong results. So, for a time we've viewed it as companies needing to kind of grow their way into these valuations. We're seeing that happening. And more importantly, as we look forward the next 6, 12, 18 months, the very favorable backdrop that we have today is expected to continue. So we do think it remains a good time to be looking for opportunities particularly within the equity and convertible space. It's a bit more difficult within fixed income markets where valuations are also somewhat high, but we don't expect material decreases in longer term interest rates from these levels, which will certainly challenge those markets to deliver attractive total returns.
When thinking about generating stable and consistent income in this low interest rate environment, how can a balanced fund be used in a portfolio or thought of as a core position potentially?
Yeah, when we think about the current environment and in particular the challenge of maintaining an attractive, stable, consistent level of income in a multi-asset portfolio, it really comes down to the flexibility of the kind of investments you can make. So this has been a period that's really demonstrated that as we progressed through the pandemic and experienced the tremendous bifurcations that were happening within financial markets, to have a very targeted tactical approach to look for opportunities to change the aspects of the portfolio and be dynamic first and foremost, focusing on that important level of stable and consistent income is really the key. And that's certainly something that is a big part of the approach that we take within our Franklin Income Fund.
So let's talk about Franklin Income Fund. What are some of the advantages that you see to investing in this strategy, and how do you think about producing risk-adjusted returns in the fund?
Yeah, well, Franklin Income Fund, I think we have a long track record of approaching investing this way, and we certainly have a very experienced management team, but more importantly, tremendous depth in resources that we can access across equity and fixed income analysts that contribute to our strategy. The fund has historically been managed in a way that really looks at the markets from that holistic perspective, where opportunities are and how we can adjust the portfolio's asset mix. So as we look forward, particularly against the backdrop of where markets are today and what our expectations are in terms of potential total returns and the risks that we might be taking in different pockets, this is a time that we really feel like that tactical approach is going to be key to help navigating some of the challenges ahead. Now, certainly the backdrop is favorable today, but as we look forward, whether it's changes in policy accommodation or deceleration in the growth that we do think will come, now, once again, we expect it to remain above trend, but at some point it will be decreasing, and we're going to be very closely paying attention to inflationary pressures and what kind of dynamics they can create within fixed income markets, all to the eye of this is something that we can navigate because of our dynamic approach, and hopefully we'll find opportunities that continue to deliver attractive income, but also strong return and risk measures for our investors.
So as we look ahead, if the Fed starts to tighten monetary policy, how do you think that's going to affect the market, and what changes to the asset allocation of the Franklin Income Fund would you expect?
You know, as we look forward, we certainly expect the Fed at some point to move away from its highly accommodative position currently, and that could be in the form of reduced asset purchase initially. It could be more clarity around when the Fed intends to raise short-term interest rates. But I think it's important to look back at other periods, and certainly they're all unique, but we don't have to go back that far, actually just 2016 to the end of 2018, when the Fed was in a period of rapid normalization of short-term interest rates. And I think it's constructive to look at asset markets and how they performed, and equities performed quite well. I think the Fed's intent will be normalization and not really trying to constrain economic activity. So I think that paints a very favorable backdrop for equity assets in particular. Certainly within the fixed income markets, there can be a little bit more volatility as the curve changes, and certainly other dynamics will influence longer term interest rates, but that's an area that we're very mindful of the potential risks, and also as rates normalize and the curve changes, we'll be looking for opportunities for our portfolio.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。